Welcome, everyone. My name is Trista Polo. I'm a debt shredder representative with Shop Financial, and I'm really excited about tonight. Through a series of weird synchronicities, I was on a Facebook group and I asked a question about mortgage interest deductions. And all of a sudden, my brother-in-law, also a CPA, not just a member of my family, jumps in with an answer. And his answer was so intriguing that it led us to this moment where Elgin is going to be giving us some really valuable information that I think will make all of us more informed about how interest works with deductions and how the new tax laws could be impacting your ability to keep as much money as you want in your pocket. I want to introduce Elgin so that he can kick off his overview for us. Now, Elgin's a partner at the South Florida-based public accounting firm known as KSDT and Company. His full CV, his resume, is available if anybody needs it. But I just want to highlight that Elgin is a Florida licensed certified public accountant. He received his education, his MBA from the University of Miami and his BS in accounting from Binghamton University. He's in charge of the forensic accounting and business valuation portion of the practice. He has over 20 years of public accounting experience focusing on accounting and income tax, as well as over 15 years experience to testify as an expert in litigation support, forensic accounting, and business valuation services. He's commonly called to court to testify as an expert witness in various litigating cases, including civil disputes, divorce, paternity, guardianship, probate, and trust matters, as well as personal injury cases. Now, in addition to the practice as a forensic accountant and business valuation expert, Elgin provides business tax and accounting guidance to small businesses and their owners. He serves as an adjunct professor teaching fraud and forensic accounting at Florida International University, and he's been doing that since 2009. He's fluent in Spanish. He loves to solve puzzles, especially when their numbers are involved. He's my brother-in-law. I have such a huge level of respect for him, and he loves accounting. So I'd like to introduce Elgin Polo. Welcome.
Thank you so much, Trista, and thank you again for our audience for tuning in tonight to have me go over some of the unique aspects of the new tax cut law. I want to thank Trista again for setting up this opportunity for me to discuss the changes in the tax laws and how they will impact real estate investors. And it's not just any real estate investor, it's ones that own their own home or invest in real estate for rental income. There are a lot of material to cover. So I would like to start with an example to help illustrate some of the significant changes related to the deductions of interest expense under the tax law. The first thing is when we refer to, some people refer to it as a Trump tax cut, but it's actually the TCJA, the Tax Cut and Jobs Act. It was signed into law at the very end of 2017 and impacts all taxpayers for 2018 filing year and for the next several years. We're going to go through an illustrative example of one of my clients and discussing the concept of itemized deductions. And then I'm going to go through another illustrative example discussing another one of my clients with the real estate investment aspects. Part of the big takeaway that I want to give is there was a lot of changes in the tax cuts, and it was basically a corporate tax cut that reduced the corporate income tax rate for large corporations from approximately 35% rate down to 21% rate. It was actually set to go down to 20% through legislative Congress. They couldn't afford to pay for the projected deficits, so they had to make some certain changes to the way individual taxpayers are taxed to order for the TCJA not to be so budget exploding. And that's what we're going to talk about with the changes in the itemized deductions. So let me jump right into the example. So I have a client, Paul and Maria Garcia. They were married in 2008 after they got out of graduate school. They were able to purchase a home in 2013 for $278,000 with a 5% down payment and finance the property with a 90% first mortgage and a 5% home equity loan. They had 2 children. Their daughter was born in 2013 and their son was born in 2015. This is part of the illustration, but there's some facts that help me with doing my tax calculation. So you're understanding it's a family of 4. Paul works in an insurance company and he currently earns approximately $70,000 a year. And Maria is a manager of a retail store and currently earns about $50,000 a year. So the combined income currently is about $120,000. The mortgage that they took out about approximately 5-6 years ago was a 30-year fixed mortgage with an interest rate of 4.125%. And if you want to look at the amortization of that, the actual monthly payment is $1,213 per month. The insurance is $125 a month, and the real estate taxes are $300 a month. So you can determine what their monthly payment for housing is as it relates to their combined incomes. They also took out a home equity loan to close on the loan, the mortgage. They paid down that home equity loan slightly, but it's basically interest-only loan for the first 10 years of the loan, and that's set at a prime rate plus 1%. So keep in mind that there's a couple different pieces of debt that we have here. The Garcias also have some consumer debt, some credit cards that they've accumulated. They're currently playing that 0% balance transfer game. They're currently under a 0% rate on their consumer credit card debt, but it's projected to increase in about 6 months to 15.9%. There's some student loan debt still lingering around from graduate school that has about an interest rate of 4.5% and approximate monthly payment of $344 a month. Here's where I want to get into. There's certain different types of interest deductions. Now, historically, before the TCJA, mortgage interest was going to be fully deductible. And we're going to go through the example of how it was aiding the Garcias in bringing down their income taxes. Now, second mortgage interest, that is typically deductible as well, but now there's new rules that may not make it as favorable as it was in the past. And the student loan interest, it's currently deductible for the Garcias, but we're going to discuss a little bit later why that may not necessarily be tax preferential going forward in the future. And most people know credit card interest is not a non-deductible expense. That changed in the 1986 tax law. It hasn't been deductible for a long time. So understanding that there's typically favorable types of interest deductions and there's unfavorable types of interest deductions. And we're going to see through this illustration how the mortgage interest is going to potentially change based on the TCJA. So in analyzing the mortgage interest, they're about 5 years into the payment plan. So if you look at the amortization, only about $433 of that monthly payment is actually going to pay down the loan, and there's approximately $780 a month of interest expense. And that accumulates to about $10,000 a year in mortgage interest. So we're going to see that number play forward. The home equity loan, it's not amortized, it's interest only. Prime is currently at 5.5%. So their monthly payment on that home equity loan is currently $68 a month. And now you have to keep in mind that prime rate is adjustable. Typically, it adjusts from time to time. It hasn't adjusted recently, but it's likely to change in the future. Now, I don't want to scare anybody, but we're going to talk about tax forms. And part of it is understanding where things go on forms. And this isn't a lecture designed to help you prepare your income taxes. It's just to illustrate where certain things can go and not go. And the new design of the 1040 form is a little complicated because there's so many subschedules. And for those of you who have prepared your own returns, you're gonna have to understand that there's certain testing now that needs to be done for mortgage interest. This is part of publication 963. And this is a little dizzying, I understand that. But the big takeaway from this flow chart is that mortgage interest may not be deductible based on your facts and circumstances. The first test that you have to determine whether mortgage interest is going to be fully deductible on your tax return is whether you itemize your deductions or not. So if you don't itemize your deductions and you take a standard deduction, then the mortgage interest is not going to be helpful. Now, typically, we talked about in this example, they have $10,000 of mortgage interest. Well, gosh, with that, with the real estate taxes and the, they live in a high income tax state like New York, like my brother and sister-in-law, they're going to have plenty of itemized deductions, correct? Well, hang on. Let's take a look at how this example flows out, because how much mortgage interest you can deduct has to do with when you took out your mortgage and whether it's secured by your first or secondary property. So they've changed certain things. Big takeaway is if you hadn't closed on the loan prior to the beginning of 2018, or actually were in a contract to close, you can now only deduct interest up to $750,000 if you're filing joint, and $375,000 if you're filing separate. That's a big change because you typically could deduct all the mortgage interest up to $1 million of loan previously. So that has come down quite a bit. So not all your mortgage interest may not fall on Schedule A just because of statute. There's some other key terminations that you have to determine about whether your mortgage interest is going to be deductible or not. As I said before, you have to be able to itemize your deductions, and the loan must be secured by a qualified home. Taxpayers that have multiple properties as investment for long term, they're not going to be able to deduct the interest. They're going to have to capitalize it, which means they basically accumulate that in like an accounting scale, and you can use that when you sell the property in the future. There are some provisions where there are debts that can be grandfathered in related to home acquisition debt. But keep in mind, the home equity loan. Now for the Garcias, they took out their home equity loan to purchase the property. That's the key takeaway. The new rules regarding the deductibility of home equity loans is even more complex. First, you must be able to itemize, which we've discussed, to receive any tax benefit. The second, equity loan must qualify. There are limits, and the limits apply to whether you have over this amount of interest. Now, in the Garcia's case, the two loans are under the $750,000 amount, and because they took out these loans years ago, it's under the $1 million, so they would be able to deduct the full amount. But the key difference under the new TCJA as compared to old terms is you have to prove that you have used this to improve or purchase your home. Now, a lot of loans have been made on secondary markets where you get some equity loans, and the equity loans are typically used as debt consolidation. And if you're using a home equity loan for debt consolidation, it's personal interest. And I say personal, that's like paying off your credit card, your boat, your car. It's not a good, if you're looking for the tax write-off, it's not the way to go on that. So this might be one of these issues where we're going to decide whether this is going to be a valuable deduction for the Garcias. Now, here's the meat of this particular scenario. Under 2017 tax law, the standard deduction was $12,700 for the Garcias. But when we filed their tax return, they had itemized deductions of $22,082. And that included the mortgage interest of about $10,500. Now, the difference would be their charitable contributions and their real estate tax deductions, as well as other miscellaneous itemized deductions. Now, the TCJA has eliminated a lot of the miscellaneous itemized deductions. Like you can no longer deduct the holy grail of deductions, which is your tax preparation fees. No, I'm sorry. But at the same point, you can't deduct certain employee expenses anymore. So these itemized deductions, they've reduced these items to help pay for the overall tax package to help bring down the cost of the reducing the corporate tax rate. Now, under 2018, we've determined that when we prepared their return, their itemized deduction was $21,864, which included approximately $10,100 of mortgage interest. That was on the first loan and the second loan. But the TCJA increased the standard deduction from $12,700 to $24,000. So as you can see, we took the standard deduction for this couple, so that no longer are we going to be itemizing their deductions. As you can see, their itemized deductions are nearly $3,000 or $2,136 less than the standard deduction. So now that you're taking the standard deduction, all the tax preferential items like mortgage interest, real estate taxes, state income taxes, charitable donations, all of these, even medical expenses if you qualify, all of those amounts aren't going to be tax favored for the Garcias because they're just going to take the standard deduction. It makes preparing their return a heck of a lot easier now. And that was the real goal of when you looked at the Joint Conference Committee when they were trying to reconcile the tax legislation in Congress. The goal was to have it on a postcard. I think that's everybody's holy grail, is to have taxpayers to be able to prepare their tax return and put it on the back of a postcard and make it very simple. Well, by doubling the standard deduction, not technically doubling, but from going from $12,700 to $24,000, they've eliminated many taxpayers from itemizing their deductions. And this standard deduction goes to $24,400 for married individuals next year. So as we can see, when we did our tax projection for 2019, we projected the mortgage interest would be $9,700 and their total itemized deductions to be about $21,500. Again, they're not going to get any preference or any benefit of the itemized deductions, and we're going to take a standard deduction going forward. So here again, if they could eliminate these mortgage interest deductions, it's not going to have any impact. And let me say again, zero impact on their tax bill. So whether they have the taxes or not is not going to have an impact on filing their returns. Your marginal tax brackets, I threw this in. Knowing what your marginal tax rates is, there's 7 different brackets, and you can see what falls in a specific way. For the Garcias, their tax rate, after you take out the $24,400, they're going to be in the 24% marginal rate. So knowing, I'm sorry, I'm in the wrong column. It's the bottom quadrant. So the one that's actually underlined, they're in the 22% tax bracket. So knowing their marginal rate of 22%, we can now determine what would be preferential item for them. So if there are certain types of items that they can deduct, their marginal rate. Now, marginal rate is kind of complex, but it's knowing where you are. It's how much each new dollar. So if the couple makes $120,000, how much more will they be taxed if they earn another $10 of income? They're going to get taxed at a 22% rate, and their income would have to go up to $168,000, not their gross income, their taxable income would have to go up considerably before they go into the next bracket. And as you can see, the next bracket is pretty shallow, from 22% to 24%. Perhaps it's not as exciting as the NCAA basketball brackets, but these are taxpayer brackets that us accountants get to talk about. All right, so is there a tax benefit of the mortgage interest? I think I hit that. So previously, when we were doing their itemized deductions, their tax bracket was 25%. So 25% of their mortgage interest, or if they had $10,000 of mortgage interest, $2,500 was reducing their taxes. So it was benefiting them because they were itemizing. So now that they're not itemizing anymore, there's no longer any benefit starting in 2018 due to the TCJA. An amount previously reduced their income taxes no longer benefits them at all. So this 4.125% rate that they're paying, it used to be paid with pre-tax money, meaning that the government helped them conceivably pay their mortgage by giving them a preferential item on their income taxes. Now it's paid with after-tax funds. So the actual cost of their mortgage payment in real dollars has actually increased. I mean, it's a dollar for dollar. It's quite a bit of, I believe it's a more cost for them to carry that type of debt. Now, we mentioned student loan debt. There's tons of things. Yes.
Sorry to interrupt. Can we pause for a question or two?
Sure, of course.
Oh, great, because I'm definitely not an accountant. I don't even play one on TV. I was just curious, can you explain marginal rate for our audience?
All right, well, with your marginal rates, you're trying to determine what would be the benefit of $1 of deduction. So the example is, I have a client, we prepare their tax return, I send them the proposal, and they say, you know, what can we do to get my taxes lower? And every person asks their accountant that. And I start going through and trying to determine what type of deductions they forgot. And I say, well, what should I do next year to help reduce my taxes? Should I give more to charity? I'm like, well, you can give money to charity, but you got to really like the charity, because let's assume you're in the 25% tax bracket. 75% of that is going to be paid by you, and 25% is going to be paid by Uncle Sam. So the marginal tax rate shows you what rate you would benefit by making another dollar of deduction. So the same point, if your tax rate is 22%, that means that more of that's going to come out of your pocket, and you're going to want to enjoy the deduction if it's charity by 78% to get that 22%. Now, in the Garcia's case, they make money they give money to charity because they think it's the right thing to do to support the causes they have, but they get no benefit from Uncle Sam. So that's what the marginal rates would be.
Oh, okay, great. That really clears it up for me. Now, let's say that the Garcias were not married. Would that change things for them at all? Is it better to be married or not married these days? Tax-wise, that's my question.
Well, it depends on the filing status. Because we have two children in this example, they could be, let's assume they're going through a divorce. They could each be qualifying as a preference called head of household. And head of household is a more tax preferential treatment, where basically your marginal rates, they don't get as high as quickly. So if they both qualified as head of household, they claim one child per return, their standard deduction would be $18,000 instead of half of $12,000, half of $24,000, which would be $12,000. So it would even make it more beneficial, because I mean, let's assume that there's alimony or no alimony, but they split the mortgage. I don't know how they're going to divvy up their estate in this theoretical quickie divorce, but as it relates to whether you're filing single, whether you're filing head of household, whether you're filing as married individuals, this all applies evenly. So you have to speak with your tax advisor to see how your marginal rates are and whether taking the standard deduction is going to be beneficial to you ultimately. But what I hope this presentation illustrates is that the benefits that most people thought they had by itemizing their deductions, which we've been educating our clients for over a year now, not a lot of people have been educating the broad public about that. There's not a lot of information being distributed, basically saying, because it's these items like real estate taxes, mortgage interest, nobody wants to pay these items, but at least they think, well, at least they're going to reduce my taxes. But that's not the case anymore. Now, getting back to the slides with the student loan interest, it may be deductible, but look at the income qualifier. So if you're single or head of household, once you get over $65,000 of income, and this is the term MAGI, which is the modified adjusted gross income. AGI is the number on the front page of your income tax return, and any certain preferential items get added back into that, and that's how you get to the MAGI. But if you make over $65,000 as a single or head of household, there could be an effect on your student loan interest. If you're filing married, you'd have to have income over $135,000. Now, the couple is fully able to deduct their student loan interest, but as you can see, as their income continues to increase, it's going to get phased out or reduced. So it could be an item that they're currently getting a benefit for. Now, you get to deduct student loan interest whether you itemize or take the standard deduction. So currently, student loan interest, if you fall underneath the caps, is a beneficial item for you. And it may not be, it will be reducing your income taxes. Now, obviously, if your student loan interest is a lot, if you're carrying large amounts of loans, the interest over $2,500 is of no benefit to you. So it's only the first $2,500 of student loan interest that's going to benefit you on your tax return. And once you get over these thresholds, it's zero. And then as I wanted to slide into the rules for rental real estate rentals. Once again, I'm not going to explain the why you should get into rental real estate. I'm not going to explain who should be reporting, the what, the where, the when, and the how. That's for late night infomercials on real estate investments and outside the scope of what we can cover in this short time together tonight. But what I want to discuss is there are a lot of rules, and IRS Publication 527 limits a lot of the ability to deduct certain types of losses on real estate. There are at-risk rules. There's passive activity rules. There's qualifications of whether you're a rental real estate professional. These are great takeaways to discuss with your tax professional if you're involved in investment properties. But what I wanted to just point out in this example is that there are modifications under TCJA that make mortgage interest less favorable for rental investment properties. You're still going to get a benefit to deduct it, but it's not going to be as favorable. So let's assume that the rental property that the Garcias have is $150,000 of value. And let's assume it's rented at $1,000 per month or $12,000 per annum. And they have monthly debt service on their mortgage of $600 a month. And they have other rental expenses, including their insurance and their taxes and their maintenance, about $200 a month. So if you quickly look at the math, it looks like it's net cash flow of $200 a month. Now, when you do the income tax return, you're going to actually get a taxable loss because of the magic of depreciation expense. And those that are in real estate investments, that's one of the big drivers of why people invest in real estate, which is basically if it's residential real estate, you can deduct the property value that you purchase over a 27.5-year period. And if it's a commercial property or multi-unit, it's a little bit longer. The TCJA gives you a lot of benefits of deducting depreciation. If the service life of the asset that you're buying is less than 20 years, it can be fully written off in the first year, depending on your income limitations. And I mean, it's a very large income limitation. So once again, speak with your tax professional about this, but keep in mind that tax loss wouldn't be deductible for certain taxpayers. So under the example, when I was dealing with modified adjusted gross income of over $100,000, they can deduct a loss up to $25,000 if their AGI is less than 100 grand. If their AGI or MAGI is greater than $100,000, they can only deduct a portion of the loss. So if you have a large loss on rental properties, it may not be fully deductible unless you meet certain special carve-outs for rental real estate professionals. But once your income goes over $150,000, there's no special deduction allowance. You don't qualify for any of the benefits of taking these tax losses. So in determining whether this is a benefit to a real estate investor, you have to look at whether the person meets specific criteria. So are they going to be suspended? Are there going to be tax preferentials? I mean, the honest truth answer is a lot of the answers are going to be, it depends on the circumstances of the investor. But I think what the takeaway for our audience tonight is if someone comes up and says, the question that was posed on that open chat on Facebook by Trista was, I have someone that is buying multi-units as an investor and it's a tax write-off. And what I want to answer as a question is, what would I say to this investor if they're so worried about the tax write-off and whether they should try to avoid paying off the mortgage as fast as possible? And the answer to this question it kind of stimulated this whole discussion and developed into this webinar. But clearly, more information would be needed for me to answer the question that was put online. But understanding the facts and circumstances of what a real estate investor is involved in, someone who has a full-time job and is investing in multifamily properties, let's assume their income's over $150,000, they're not going to qualify for taking tax write-offs. They're not going to have it because of the new TCJA has limitations that eliminate that particular type of provision. Unless they're a professional landlord and that's all they do, then you're not going to get a significant benefit. So if you're not able to deduct something and you're not able to get the benefit, then wouldn't it be better to pay off the mortgage quicker and maximize the cash flow that you have on that property? Is that $200 of positive net cash flow under my example? Should that be rolled back into paying off the mortgage quicker? I think these are questions that you can have and have clear examples of why these benefits that used to be under the former tax law are no longer because they basically closed a lot of the provisions for people that invest in real estate in taking these tax laws. Now, it gets even more complicated. I'm sorry. There's the qualified business income deduction, and the QBID is explained under Section 199A. And basically, when you have a pass-through entity or rental real estate, you can get a 20% deduction of the total amount of the income from determining. This is not an above-the-line deduction. This is not an itemized deduction. It's a between-the-line deduction, which means you can deduct whatever the income is by 20%. Now, obviously, there's a lot more to cover about the QBID. I don't want to get into the full scope of this. This is not the scope of this presentation. But what I want to discuss is that there are certain types of qualifying amounts that, as you can see, if you meet certain criterias and you have 250 service hours, you can benefit from real estate tax deductions. But once again, the takeaway for your audience is this is something that you want to have an open discussion with your tax preparer. Is my rental real estate, am I going to benefit by having large deductions? Well, the example, the Garcias are in a 22% marginal tax rate. So whatever income they generate from their rental property, they're going to get a 20% deduction on that. So that reduces their 22% tax rate to 17.6%. So if you're paying a mortgage interest dollar and you're only getting 17.6 cents back, you're not getting the same full benefit that you had previously. So I guess really what I wanted to see if I can kind of wrap up is that there's been a change in the real estate tax laws that are creating that benefit that taxpayers would have, whether they're investing in their own home or whether they're investing in rental real estate investments. We've had a hard time educating our clients about these tax preferential items. And I can imagine other accounting firms are having the same similar issues. The goal of what we discussed tonight is to show that there's been significant changes to how it impacts our clients, friends of the firm. You're not necessarily having that same benefit. So if you're hung up on, well, hey, my mortgage interest is such a valuable deduction because it reduces my income taxes, I wanted to basically illustrate that that's not necessarily the case. Did we have any questions that I can jump into?
Yes, one person on the broadcast asked what a phase out is. You mentioned it a few times in the student loan slide.
Right, so in phase out, in essence, you can take 100% of the deduction, and then when you get over a certain threshold, so with the student loans, if you're single, once you make $65,000 and $1, that $1 reduces the amount of your deduction. So if you make $70,000, you have to take 50% of the $5,000 over the $65,000, and that's going to reduce your itemized deduction. So it's slowly, it's like the moon. It changes from full deduction, full moon, to a crescent moon, or zero, or a new moon. And so you're going through that whole phase of whether I'm getting 100% or I'm going to get 0%.
That really helps. thank you. I know that you had said the conclusion of all of this is that the mortgage interest just isn't what it used to be. It just may not be as valuable. And certainly people should consult their tax advisor to look at their personal situation. But we are getting so many great comments of, people really enjoying the information. Now, Elgin, if the mortgage interest is not what it used to be, then I know you and I actually had quite a long conversation about the fact that paying your mortgage down as quickly as possible is probably the best idea for most people. I know that you and I have talked a lot about debt shredder, so just wanted to put that into the conversation because I know we do have some guests.
No, I agree, and I've recommended clients, and will continue to recommend clients that meet certain criteria of having debt, free cash flow, to watch some simple videos online, to meet with a debt shredder agent. There's a lot of content. I've gone through the materials, and I'm very fond of the program, and I will continue to refer clients as well. And I think it's a great opportunity to have a discussion. And now you have something that you're paying on a monthly basis, you're no longer getting benefit for. It's similar to your credit card interest. You don't get any benefit for the credit card interest. Now, your facts and circumstances may lead you to believe you're not getting any benefit of mortgage interest because you're taking the standard deduction. And if it's going to be the same way, why not reduce that debt? Why not reduce the mortgage interest? Why not create some wealth in your family?
Absolutely. I completely agree with that. Now, the debt shredder is available as an analysis for each person. So just like each person's tax situation is different, so is each person's debt load situation. We do an analysis so people can see exactly what it would save, how much interest it would cancel, and what kind of wealth. So I want to thank you, Elgin, so much for being on this webinar. It was very generous of you to spend your time, certainly after tax season ended. So the question came at the perfect time. You kept it really simple, easy to understand. I want to thank you for that as well.
Well, it's my pleasure. And anything I can do to help support you and your audience, by all means, please consider me a resource to have it in your Rolodex.
Thank you so much for that. I also know that you had offered some follow-up documentation if people were interested in delving deeper to any of these topics. So I wanted to mention that if anyone on the webinar would like to get access to those resources, you can just request that information from the person that invited you to this webinar. If you want to know more about the debt shredder software and how it actually works, we're going to be doing a 30-minute overview next week at this same time, Monday at 9 p.m. Eastern Time, and access to that webinar is available through the person that invited you as well. I'm just looking through to check for any final questions. We're getting a lot of thank yous, people really enjoying the information that you covered, Elgin, thanking you for the information, agreeing that it was very accessible, and just a lot of kudos and positive feedback from our audience. And so, yeah, again, I want to just thank you, Elgin, for being on tonight. Do you have any final words to close us out before we end for tonight?
No, once again, any evening where I can sit and talk about income taxes is a pleasure for me. And obviously I wanted to help Trista, and I think the world of you and your organization trying to see what we can do to help people create some wealth in their homes. And I think the debt shredder is something that must look at. So if the person that was kind enough to invite you to this seminar, you should reach out to them and talk about doing an illustration. It may create quite a bit of wealth for you.
Awesome. Well, thank you, Elgin. Thank you to our attendees. Thank you, Charlie, for making this information available. Good night, everybody.